So now we're to the part of preparing financial statements. So you can see that this process is very similar to what we talked about in chapters 1 and chapter 2. The main thing that we've added now is those adjusting entries for revenues and expenses. This helps us to prepare our accounting records to be complete for our financial statements. Um, and follows US GAAP requirements to match revenue to expenses. So we had our regular transactions, we prepared journal entries, we created a trial balance, and then we created adjusting entries. After the adjusting entries, you create an adjusted trial balance. Okay, so you can see there's an example here of an Excel file where we have our unadjusted trial balance. So that's the trial balance that we learned about in chapter 2. And then we have our adjusting entries. So these are the entries that we made in our example, or we talked about through the PowerPoint presentation, the adjustments that we made to expenses, to supplies, to prepaid insurance, to record accumulation, to recognize revenue. We then have our adjusted trial balance, which shows the changes that we made between when we created our first trial balance and made our adjusting entries. So this is all part of the end of month cycle or end of period cycle that happens in accounting. So one thing to note here is that adjusting entries never affect cash. So this is a very, very important thing to remember. Adjusting entries never involve cash. Okay. After we've prepared the adjusted trial balance, then we can prepare the financial statement. So the first financial statement you always prepare is the income statement. Revenues minus expenses. Once we have the net income, then we can prepare the statement of retained earnings to know that we're going to adjust retained earnings for our balance sheet. We then create our balance sheet, and the last statement we create is the statement of cash flows. So, as I said previously, we are going to have an entire chapter on how you prepare statements of cash flows at the very end of the semester. So we have this example of all of our financial statements and how that information comes from the adjusted trial balance to the financial statements. This is just like we did in chapter 2 with the trial balance, and then we made the financial statements. This is exactly the same exact process. The only thing that changed is that we did those adjusting entries to record revenues and expenses. The very last thing that happens as part of a full accounting cycle that closes our books. Okay, so the closing entries prepare us for a new accounting year. Most companies only close their book every single year. They have to do it once a year. So at the end of your fiscal year, you close all of your what are called temporary accounts we're going to talk about, and then um, we reset for the new year. What gets closed are those revenue and expense records, okay, and the dividends account. All other accounts stay open. So the revenue accounts, the expense account, and the dividends account. And when I talk about closing them, what it really means is they get emptied. After the closing process is finished, the revenue, expense, and dividend account should have zero balances. Okay, this prepares them for the next accounting cycle and follows US GAAP. So we talk about revenue should only be recognized in the accounting period in which it is earned. Expenses should be matched to the revenue of the accounting period. That means that revenues and expenses are unique to that one accounting period, and they shouldn't be carried over from one accounting period to another. Okay, so it's the revenue, expenses, and dividend accounts. They're the only ones that get closed. They're also called temporary accounts, where your balance sheet accounts, cash, accounts receivable, accounts payable, all of those accounts that appear on your balance sheet are called permanent accounts. Okay, so here, temporary accounts and permanent accounts. So the temporary accounts, revenues, expenses, and dividends, and permanent accounts are your assets, liabilities, and equity that are all listed on your balance sheet. So you have probably noticed during chapter 1 and chapter 2 that revenues, expenses, and dividends are never on the balance sheet. They only show up on the income statement. Okay? The only thing from the income statement that shows up on the balance sheet is net income as it pertains to the changes in the retained earnings account. Okay, so to record the closing entries, so we close the revenue account. The revenue account has a credit balance. So we are going to debit the revenue account for whatever it takes to make it zero. Then we close the expense account. We take them all to zero. Okay, and we close these accounts into a temporary account we call income summary. Income summary is only used to record closing entries. Once the income summary account has the revenue minus expenses in there, we close that to the permanent account of retained earnings that is on our balance sheet, and then we close the dividend expense account. So we'll look at this example here. So we have all of these expense accounts. The expenses add up to $4,365. So we have those in income summary. Then we have all of our revenue accounts. Our total revenue is $8,150. That shows that what's remaining in income summary is $3,785. That should match your net income. Okay, so remember that that balance in income summary after you close your revenue and expense accounts should be exactly the same as what your net income is on your income statement. We then close that to retained earnings and we close the dividends account. Okay, then we create a post-closing trial balance. What is on the post-closing trial balance should only be the accounts from your balance statement. There should be no income statement accounts on the trial balance. As always, debits have to equal credits. This is true of our accounting equation also. Assets have to equal liabilities plus equity, and debits always have to equal credits. So as you can see here that the only accounts listed on this trial balance are balance sheet accounts. Once we have this, then we are ready for the next accounting period to begin, and we would journal transactions. So then we go to the accounting cycle that we talked about in chapter 2, where we have daily transactions that we record in our accounting records. First, we create journal entries, and then we post those transactions to the T accounts. Once that is done, once we get to the end of the next accounting period, then we would go through these adjusting and closing processes to prepare for the next accounting period. Okay, so this entire accounting cycle, analyze transactions, journal, post, prepare the unadjusted trial balance, prepare adjusting entries, prepare the adjusted trial balance, prepare financial statements, and then we close those temporary accounts or those income statement accounts, and then we prepare a post-closing trial balance. Next, we're going to talk about a classified balance sheet. So what a classified balance sheet is how we organize a balance sheet. So as we move through the class, we're going to be changing the formatting of these financial statements. We started out with just the most simplest of formatting for these financial statements, and now we're going to talk about a preferred format for balance sheets. So classified balance sheet separates our items into current and non-current items. So current items are within a year or operating cycle. So that's the official term, within the longer of 1 year or the company's operating cycle. This is our fiscal year. So what the company has decided, it can be January 1st to December 31st, but companies don't have to use a calendar year as their fiscal year. For example, almost all schools, K through 12 and universities, use July 1st to June 30th as their fiscal year, to take into account that most of their business starts in August and ends in late May. Okay? So current assets are those things that are expected to be used up within 1 year. Current assets are cash, accounts receivable, inventory, supplies, prepaid expenses. Long-term investments are expected to be held for a long time. Long-term investments are things like buildings, equipment, land. Um, these are sometimes also termed as property, plant, and equipment, and some financial statements will just call that PP&E, and PP&E standing for property, plant, and equipment. Our plant assets, so these are those long-lived assets used to produce and sell products. These are our buildings and equipment. And then we also have what are called intangible assets. So we really aren't going to talk about intangible assets for a couple of chapters. I think it's chapter 8, where we really get into intangible assets. But what intangible assets are things like patent protection, trademark, copyright protection. So these are really important assets of the company, but they're not buildings, they're not equipment, they're not land. So they're called intangible assets. Current liabilities. So current liabilities are things that are going to become due soon, accounts payable, salaries payable, unearned revenue, taxes payable. And then long-term liabilities are those long-term payments. Some things would be like a mortgage payable, a long-term note payable. So if we have a note payable, we've talked about like 60-day notes that people have taken out. But if we took out a 5-year note, that would be a long-term note. There are other long-term liabilities that we're going to talk about in a later chapter. And then equity, the equity account is the owner's claim on assets. So this is our stock account and our retained earning account. Right now, we're just talking about common stock, but when we get to the equity chapter, we will talk about other types of stock that a company can have on the balance sheet. As I said, we start out with just the basics in chapter 1, 2, and 3, and then starting in chapter 4, we start adding on all of the other stuff. So we're going to have a couple of chapters just looking really, really deeply into asset accounts, learning all kinds of different rules and stuff on asset accounts. Then we have 2 chapters on liability accounts, then a chapter on equity accounts, and then the chapter on statement of cash flow. Okay, this last slide is looking at using Excel as a worksheet for our trial balance. So what that worksheet looks like is it contains all of our adjustments, closing, trial balances, and everything. So this is the example of that worksheet where we have our unadjusted trial balance, then we have our adjustments, our adjusted trial balance, the income statement information, and then we would also have columns for our closing entries and our post-closing trial balance. So that is the end of chapter 3.